Why don't we get started? Welcome, everybody. I'm John Haigh. I am the co-director of the Mossavar Rahmani Center for Business and Government. Thank you all for coming. We are extremely fortunate today. We have Dr. Adriana Kugler with us. And just a little bit of background, she is a member of the Board of Governors of the Federal Reserve. And just to put that in context, there are only 7 members on that board, one of them being Chairman Powell. And so it is a rather august group. Prior to being on the Federal Reserve Board, she was the U.S. Executive Director of the World Bank Group. Prior to that, she was at Georgetown University. And as we know in the Harvard context, you can get a leave of absence for a few years if you get some position like being governor of the Federal Reserve. And so she is a professor of public policy and economics and was vice provost of faculty at Georgetown. She was the chief, prior to that, she was chief economist at the U.S. Department of Labor back in 2011 to 2013. And she's also at the National Bureau of Economic Research and the Center for the Study of Poverty and Inequality at Stanford University. And then a couple other pieces of interesting information for me as a bit of an academic. She was elected chair of the Business and Economic Statistics section of the American Statistical Association. So not only is she an economist, but she is a numbers-oriented economist and a math-oriented economist, so all positive. She is on the board of Science, Technology, and Economic Policy at the National Academy of Science. And she received her PhD from Berkeley in economics. So with that, I'm going to turn it over to Adriana. She's going to talk, just to put it in context for you, she'll talk for 30 minutes or so. I'll have a few questions I ask her, and then we'll open it up. You'll get your opportunity to ask your questions. I only have a couple of requirements on the questions at the end. First of all, identify yourself if you can. Secondly, try to limit yourself to one question if possible. And just keep in mind that a question ends with a question mark, okay? We like to keep it that way. So Adriana, it's all yours.
Well, thank you, John, for that generous introduction, and thank you for the opportunity to speak here today. It is great to be back at the Kennedy School, and in particular here at the Mossavar Rahmani Center, which has a long tradition of engaging on important policy issues. In my remarks today, I will provide my outlook for the US economy and the implications for monetary policy. The combination of significant ongoing progress on reducing inflation and a cooling of the labor market means that the time has come to begin easing monetary policy. And I strongly supported the decision last week by the Federal Open Market Committee, or FOMC, to cut the federal funds rate by 50 basis points. While future actions by the FOMC will depend on data we receive on inflation, unemployment, and economic activity as well, if conditions continue to evolve in the direction traveled thus far, then additional cuts will be appropriate. I will begin by summarizing where we stand on inflation, including details on how the different components of inflation have changed over time, since these facts form the basis for my judgment on where inflation is actually headed. I will then talk about the recent cooling in the labor market and the forces driving it, as well as how shifts in this other side of the mandate fit into the overall economic outlook for the rest of this year. I will conclude with implications of all this for appropriate monetary policy and our focus on the dual mandate that we have here in the US. Inflation based on personal consumption expenditures, or PCE, has come down from a peak of 7.1% to 2.5% in July. Core PCE inflation, which excludes energy and food prices and tends to be less volatile, has come down from a peak of 5.6% to now 2.6%. Based on consumer and producer price indices, I estimate headline PCE and core PCE inflation to be at around 2.2 and 2.7% respectively in August. And of course, we will get these numbers in a couple of days. The progress on inflation is good news, but it is important to remember that households and businesses are still dealing with prices for many goods and services that are significantly higher than they were a couple of years ago. Prices for groceries, for example, are about 20% higher than before inflation started rising back in 21. And while earnings have been rising faster than inflation, it may take some time for it to feel as though prices are actually back to normal. Inflation data are produced by the Labor Department, and when I served as chief economist at Labor, I delved into the differential effects of inflation on various demographic groups. When inflation was at its peak in 22, it was more than 1 percentage point higher for lower income households, for those without a college degree, and for those aged 18 to 29 years of age. All groups that spend a higher share of income on necessities and definitely have less wealth to draw from. Fortunately, research by the staff at the Fed shows that this inflation helps close that gap as well, something that not only that adds to my urgency in terms of returning inflation back to its 2% target. Research on the causes of inflation and the subsequent disinflation showed that both supply and demand forces have played an important role. In the past 2 years, specifically, improvements in supply, along with moderation in demand, in part due to tighter monetary policy, have both played a role in the disinflationary process. Supply chain bottlenecks, as well as the drastic drop in the labor force, contributed to the initial rise in inflation. But the resolution of these disruptions and the return of workers back into the labor force have also helped to rein in inflation. Early on, consumers shifted spending from services to goods, a development that goods producers struggle to accommodate, putting upward pressure on prices. But as the demand shock to goods unwound and consumer spending shifted back to services, goods inflation fell. Also, the increased demand due to the fiscal response to COVID-19 back in 2020 and 21 has more recently been roughly neutral on growth, as shown by the Hutchins Center on Fiscal and Monetary Policy in their measure of fiscal impact. And of course, as I will discuss in a moment, tight monetary policy has been and continues to be a moderating force on demand, primarily by raising costs for interest rate sensitive goods and services. As I think about where inflation is headed, I find it very helpful to consider how it has evolved over the past several years, and in particular, how the different components of inflation have behaved. So let me take a few minutes to walk you through those details. As I have indicated, the big picture is that goods inflation surged early in 2020 and 2021, followed by prices of services ex housing, and then housing, with some overlap along those steps. This inflation has pretty much followed the same course, but in reverse. Core goods inflation rose after almost a year of social distancing, shifting spending from services, and after production and delivery of goods was disrupted by the pandemic. We don't want to remember those days. They were not good days for any of us. But we all remember stockpiling, right, on groceries. We all remember not being able to get out and buy services and staying on goods. On a 12-month basis, core PCE goods inflation rose above zero in December 2020, reached a peak of 7.6% in February of 2022, and fell again below zero at the end of 2023. In July of this year, it was at a negative 0.5%. This recent disinflation offset still rising prices for services and helped to reduce overall inflation. Goods inflation has reverted to its long-term pattern as demand has moderated and supply chain problems have abated. This is reflected by various indices of supply chain bottlenecks that show the supply side disruptions that contributed early on to the surge in inflation have now retreated to pre-pandemic levels. Other data show that computer chip supply, for example, which fell far short of demand early in the pandemic, is now back to normal conditions as well. Food and energy prices, always subject to larger ups and downs, also rose early on. Food inflation increased in 2020 as shoppers began stockpiling groceries and as warehouses and production facilities had difficulty staffing due to COVID. After Russia's invasion of Ukraine, energy price inflation reached a peak of nearly 45%, and food inflation reached a peak of 12% in mid-2022, highlighting the importance of petroleum and agricultural commodities from that part of the world. Food and energy inflation has moderated over the past 2 years and are now both running at 1.4 and 1.9% respectively, as supply chain issues have been resolved and production here in the US and elsewhere in the world has increased as well. While food and energy expenses represent a moderate share of consumer spending, it is the high frequency of purchases of these goods that makes them highly salient in the public's view on inflation. Research by Francesco D'Acunto and co-authors has shown that the weights that consumers assign to price changes informing their inflation expectations are not based on the actual share of their expenditures, but instead on the frequency of purchases, which happens to be the highest for food and for energy. Thus, the falling food and energy prices is really important because it may feed back into lower inflation in other categories by simply moderating inflation expectations and also real wage expectations in wage bargaining by workers. Housing services price increases were the last component of inflation to escalate, rising to a peak of 8.3% in April 23 and moderating to 5.3% in July of this year. It took time for housing prices to escalate and has taken even longer for them to moderate because of both the nature of the rental market and the data collection method that comes from the Bureau of Labor Statistics, who I work closely with. However, new rent increases, which better capture rental price changes in real time, are falling and are the main reason why I expect housing services costs to moderate down the road. The final component of inflation is services ex housing, which accounts for 50% of PC inflation and is heavily influenced by labor markets. On a 12-month basis, this component of inflation rose to a peak of 5.3% in December of 2021. It stayed persistently high until February 23, but has moderated since and has moved to 3.3% in July of this year. Its escalation was driven both by the rise in labor costs and by the transition of demand from goods to services following the pandemic, which I mentioned before. Labor costs are a substantial share of the total cost for services. For example, labor accounts for between 60 to 80% of total costs in construction, education, and health services. Among the initial forces driving the escalation in wages were the increase in food and energy prices, as wage demands tend to track closely with the prices of these frequently purchased goods. Data on wage demands from the New York Fed's survey of consumer expectations indeed show a sudden increase early during the pandemic, right after the first bout of food inflation. Importantly, worker shortages likely allowed those higher wage demands to actually be realized, contributing to the rise in wages. Later, as demand for services quickly rose and employers were creating a large number of jobs in several service sectors, workers were able to be more selective, and the ensuing Great Resignation took hold, allowing people to choose indeed different careers. The relatively high demand relative to the supply of workers in some services sectors encouraged workers to move from job to job, to some of this job hopping, for higher wages, for more generous benefits, and for other improvements in working conditions. Data from the Atlanta Fed's wage growth tracker suggests that during this period, wages for job switchers grew by more than 2 percentage points faster than the wages of people who stayed in the same job, though this premium for job switchers pretty much disappeared by the end of last year. But now, inflation for services excluding housing is declining after a temporary escalation in the first half of this year that was likely partly due to residual seasonality. There had been fears that wage increases would drive this wage prices spiral as the US experienced in the 1970s. But this did not occur. To sum up, inflation has broadly moderated as the supply of goods and services has improved and as producers and consumers have adjusted to the effects of higher prices. Demand has moderated in part due to tighter monetary policy. And as I noted, changes in the pace of wage growth have also played an important role in the ups and downs of inflation, which points me towards a discussion of labor markets, an issue of greater focus for monetary policy more recently. As I have noted, there has been a significant moderation in the labor market recently. But I want to start by pointing to what really has been a remarkable performance of the labor market over the past 4 years. After the unprecedented job losses early in the pandemic, and even accounting for the quick recovery of a large share of those losses, the recovery of the labor market that followed was historically swift. Unemployment was 7.8% in September of 2020 and 4.7% only 12 months later, and it fell to under 4% 3 months after that. That is a more rapid recovery than the US has experienced since the 1960s. What started at that point was 30 straight months of unemployment at or below 4%, which had not happened during the pre-pandemic period, during the boom of the 1990s, or at any time during the 1980s. And it was only exceeded by the strong labor market of the latter half of the 1960s. Something that I think was just as remarkable has been the narrowing of the typical gap between labor market outcomes for less advantaged groups. For example, there has been a reduction in the unemployment rate between Black and Latino workers on the one hand and white workers on the other. There has also been a narrowing of the prime age labor force participation rate among these groups. And perhaps most notable, wage inequality among them has narrowed, which is not typical during economic expansions, according to research by David Autor and several co-authors. They found that one benefit of the unusually tight labor market of the past few years was the heightened competition for scarce workers, which produced more rapid wage gains for workers at the bottom of the wage distribution. The real wage gains for those in the lower quartiles of the distribution and with higher propensities to consume in turn likely spurred consumption and helped to sustain growth after the pandemic. After a couple of years in which the labor demand exceeded supply, the labor market has come into balance, reflecting an economy that has moderated in part due to tighter monetary policy. On the labor supply side, two forces have contributed to this rebalancing. Labor force participation suffered due to the disruptions in work during the pandemic, but rebounded strongly in 2022 and 2023 as the labor market tightened and wages rose sharply. The labor force participation for prime-age women reached historic highs over the past year and reached yet another historic record high in August of this year. The overall increase in participation among workers aged 25 to 54 in the prime of their working lives helped offset the loss of many workers aged 55 and over who experienced excess retirement during the pandemic. The second force boosting labor force participation has been the large increase in immigration. The Congressional Budget Office estimates that net immigration boosted the US population by close to 6 million people in 22 and 23. The majority of them of working age, and by most accounts, rates of immigration have remained high in 2024. As a result of improved supply and easing of demand for workers, the labor market has softened. After running at very low levels, unemployment has edged up this year to 4.2% in August. It's still quite low by historical standards. The slowdown in labor demand is most evident in payroll numbers. Job creation averaged 267,000 a month in the first quarter of the year, and now stands at an average of 116,000 in the 3 months ending in August. That is still a healthy pace of job creation. Jason and I remember the days of the Great Recession when those numbers came below 100,000. Yet, given recent revisions in the payroll numbers, it is important to continue monitoring additional labor market indicators, which is exactly what we do. For instance, the fall in diffusion indices suggest that job creation cooling has been broad-based, complementing the payroll data in showing rebalances in demand and supply across different sectors. Beyond payroll data, voluntary quits, which tend to reflect the rate at which people find better jobs, are now back around where they were before the pandemic. The ratio of job vacancies to the number of people looking for work, or the so-called VU ratio, has also fallen close to where it was pre-pandemic. In summary, after a period of demand exceeding supply, the labor market appears to have rebalanced. In tandem with the cooling in the labor market, economic activity has slowed, but is still expanding at a solid pace. After adjusting for inflation, GDP grew 2.5% in 23 and at around 2% in the first half of 24. Personal spending, which accounts for the majority of economic activity, has been solid this year, supported by a resilient labor market so far and high levels of household wealth relative to income. But given a rise in credit card and auto delinquencies, a rise in credit card balances, and a cooling labor market, I do expect spending to grow at a somewhat more moderate pace moving forward. Certainly, tight monetary policy has contributed to cool off aggregate demand and slow the economy. It has done so in large part by slowing spending on interest-sensitive expenditures such as housing, autos, and other durable goods. Other spending, typically financed with credits such as business equipment, has also slowed. Another effect of tight monetary policy is to keep expectations of future inflation in check. That is, to keep inflation expectations well anchored. And to the extent that expectations affect decisions by businesses to set prices and by workers to negotiate wages, this has helped to put downward pressure on inflation. Survey and market-based measures of future inflation did increase when inflation surged, but only modestly. And they have moved down in tandem with inflation and have largely returned to their 2019 levels. In conclusion, I would say that recent economic developments, against the backdrop of the experience of the past 4 years, have validated the Federal Reserve's focus on reducing inflation and set the stage for the shift in monetary policy that occurred last week. The progress in bringing down inflation thus far, coupled with the softening in the labor market that I have described, means that while our focus should remain on continuing to bring inflation to 2%, we should now shift attention to the maximum employment side of the FOMC's dual mandate. The labor market remains resilient, but the FOMC now needs to balance its focus so we can continue making progress on inflation while avoiding unnecessary pain and weakness in the economy. I strongly supported last week's decision, and if progress on inflation continues as I expect, I will support additional cuts in the federal funds rate moving forward. Thank you very much.
Now we get the chance to ask the kind of interesting questions that are not on the script necessarily.
I thought I answered some very interesting questions.
You did answer some very interesting questions. So I'll start with a bit of a softball question for you. You have talked in the past about the importance of women in economics and policy, and you've talked about the importance of data analysis merged with experience. And you are obviously a very accomplished economist. How did you get into economics? And can you talk a little bit about your kind of approach to why you chose to do what you're doing?
Thank you. Thank you so much. So, I have to kind of backtrack a little bit in terms of my experience growing up to kind of explain how I got into economics. I was born in the US, but I was raised in Colombia, South America. And I got to see firsthand poverty, and I got to see firsthand the pain and the social problems that arose because of poverty. At the time, too, in Colombia, late 1970s, early 1980s, Colombia experienced double-digit inflation. And I actually vividly remember the real cost, especially for disadvantaged households, in terms of dealing with inflation and the pain that it caused. I guess all of this is to say that I saw firsthand social and economic problems during my childhood and my teenage years. At age 15, I moved back to the US, speaking almost no English. And so in high school, I actually aimed to get engaged in activities that involve universal languages, math, music, sports. Honestly, I wasn't all that good with the sports and the music, but I was really good with the math. So I gravitated towards that, and I guess that explains why, with an interest in social issues and economic issues, and a strength in math, I decided to pursue economics. So that's where I went. Early in my undergrad years, I got to see firsthand how some women that were incredibly capable were not getting the opportunities that I thought they deserved. And so I decided I'm going to pursue the highest degree I can, a PhD, to be able to at least face those challenges if they come along. And that's how I got into my PhD. And then I decided to pursue an academic career, which has been going on for the past 25 years. I've devoted a lot of my career to study labor markets and productivity, but always with an eye on policy issues and the effects of policy on the areas of the labor market and on productivity. So I always had that interest. And I have to be honest, this issue that you raised before about how I think experiences and your lived experiences affect research has been very real for me. Many of my papers came up from actually what I was living through, what I was seeing around me, the realities around me, which drove the questions I was asking in my research. So I was very lucky when Georgetown recruited me back in 2010 to move back to Washington. And in 2011, the Obama-Biden administration offered me to go and work as chief economist at the Department of Labor during the time of the Great Recession. And I was very, very lucky to work with some incredible colleagues, an incredible team of economists, including Jason Furman here with us today, but also the late Alan Kruger, Catherine Abraham, the late Becky Blank. It was a really incredible team, and I got to learn a lot from them as well during that time. I went back to Georgetown, and more recently in 22, 23, I was executive director precisely at the World Bank, and then I got to move to be governor of the Federal Reserve System. Interestingly, the same data that I used when I was chief economist is the same data that is informing my decisions, right? The CPI that I mentioned, all the jobs reports and employment data that I pay attention to now is data that I dealt with and that I deeply analyzed together with Jason and others during the time of the Great Recession. So things kind of come back and come around.
So let me switch gears and come back to some of what you were talking about, certainly in your comments. So last week, with the 50 basis point cut at the Fed, at the FOMC, that was the first time in 4 years there'd been a cut, and so that's a significant inflection point. And to the extent you can talk a little bit about the inside baseball, how did that conversation go? Was this like a 5-minute conversation? Yep, 50 basis points, or was it like a drawn out over the day, a lot of back and forth? Was it just a really easy decision among the members, or what was the nature of that conversation, to the extent you feel comfortable sharing?
So I definitely cannot talk about the inside ball. This is all confidential, but I'm happy to share my view on how I see it. So first, let me say that the data spoke to us clearly. As I said before, inflation is heading towards our 2% target. And by the same token, the labor market has cooled. So we're at a place where inflation and the trajectory of inflation is such that we're moving towards 2%, but the labor market has cooled. It still is very resilient. It still is in a very good place, but we don't necessarily want to weaken it further. And we don't want to weaken it further because wage growth moderation has already reached a point where it is unlikely to be generating additional price pressures. So it doesn't make sense to continue to solely pay attention to the stable prices side of the mandate. We need to pivot. Totally. Sure, we will continue to commit to bringing inflation to 2%, but we also have another mandate that Congress has given us, which is the maximum employment mandate. That means right now, the way things are, with a still resilient labor market, but that one that is softening, that is cooling, it makes sense to shift attention now to that side of the mandate and to work on the two together.
So do you think there's any risk of overshooting the 2% target?
So, there's some talk out there. There's some talk, and some people who think we may overshoot. And what they're doing is they're talking about core PCE inflation ex housing. That's not actually the way we target inflation at the Fed. We target inflation on core PCE. We don't exclude some categories and leave other ones in. We focus on the full core PCE measure. So if you do look at core PCE, yes, it is true. In May, June, and July, core PCE ex housing was close to 2%. And if you look at CPI ex shelter, that measure has been even below 2% even since the middle of last year. But that's just not the way we focus on our target. We focus on core PCE. Core PCE, as I mentioned in the speech, was in July at 2.6%. We get the numbers in a couple of days for August. It will likely come in at around 2.6 or 2.7. So we're not quite at 2%. We're making very good progress. And as I said, this measure peaked as 5.6% in February 2022. So we more than halved that inflation measure, but we still have a little bit to go. So I don't see that we're gonna overshoot. That's not my baseline case. It's not my expectation. In fact, I think precisely because housing inflation is slow moving, it will still take us a little bit of time to get there. But we're getting there, and that's the important thing. The trajectory is moving in the right direction. We have seen wage moderation, which really matters, continue to come down. We have seen, as I said, anchored expectations, and we are seeing also businesses starting to moderate prices and even to reduce prices in some cases and to respond to market pressures. So the way I see it is we're getting there. That's not my biggest concern, let's say. Overshooting is not my baseline.
Small risk.
Yeah.
So, I know you are to some extent limited what you think others, but I'd like to hear your view on kind of future rates. And you talked about that. I mean, you talked about it some.
Yeah.
But if you look at the results of the meeting last week, narrow majority, 10 of 19 favored reducing rates by at least an additional half point over the two remaining 2024 meetings of the FOMC. Very few members actually signed signaled a no further action kind of forecast within the dot plot within their projections. But Chairman Powell indicated that the current course could be maintained through appropriate recalibration. And I always I don't know what that means exactly, appropriate recalibration. And I know you touched on elements of it in your talk, but can you give your interpretation or meaning of what appropriate recalibration would be?
So I think we started to already recalibrate, right? I talked about pivoting to the other side of the
To the
market.
labor
I think
market.
that is exactly what we mean. And I think the need to continue normalizing rates. So we address where we are in the process of disinflation. And by the same token, we address where we are in terms of the labor market and don't unnecessarily weaken the labor market, soften it to a point where we create weakening, and the same with the economy when it's not actually necessary because we seem to be moving in the right direction in terms of disinflation. With regards to the cuts, I would point out, you can only look at 2024, the 0 to 3 cuts that people wrote down. But it's also important to look at the next year, 25, which is only a few months down the road. And there you see many more cuts across the board, from 3 to 6 or 7 cuts. So, this is called the summary of economic projections for a reason. These are projections. They involve forecasting errors, and I think everybody understands that they have to wait for additional data, reforecast again. That could change. So maybe some of those cuts that people wrote for 25, they would be willing to move to 24 or vice versa, right? We don't know what's going to happen exactly in the next couple of meetings. But I think what is clear is that everybody thinks that our monetary policy stance is very restrictive right now. And it is restrictive, and given the conditions of disinflation, moving towards 2% target, together with a softening and cooling in the labor market, it actually makes sense, right, to continue to do some cuts down the road. So again, I say if conditions continue moving in that direction. Of course, we will receive new data. Shocks happen here in the US and around the world, so we're always paying attention to those as well. So we don't exactly know, but I think for most people, I think they feel comfortable with the fact that we need to definitely reduce the level of restrictiveness of policy, and that given the usual lags that we have in the transmission of monetary policy, we needed to start front load, start with a bigger cut, front load, and then continue to make additional cuts moving forward.
So let me touch on a couple things maybe that you didn't go into in detail in your talk. People refer to the neutral rate, and I'll define that for the audience as the real interest rate that supports the economy at full employment, maximum output, while keeping inflation constant. How has, in your mind, the natural rate changed, if it's changed at all, and how do you see it going forward?
So I just want to be clear that we do pay attention to the neutral rate, but this is not the main driver of our decisions as we go from meeting to meeting. And the reason is that this is kind of a long-term concept, right? Of moving to a situation where inflation is a target, there is a stable unemployment rate, and there are no shocks, which is very unlikely, right? We all know that. So it's not a concept that is driving our decisions meeting to meeting, but we're certainly paying some attention to that, especially as we start to normalize. And we want to eventually move there. So down the road, we will be paying more attention. I would say part of the reason why we don't pay a whole lot of attention is because there is a lot of uncertainty in terms of the measurement of the neutral rate. It's a theoretical concept, so it depends on a lot of assumptions about what we think is a transitory or a permanent change. One thing that has probably driven up that neutral rate is the debt and the increased supply of treasuries. So that works in that direction. But by the same token, there are many other factors in terms of demand for safe assets, which would move it in the opposite direction. So globalization, financial market liberalization in other countries, the aging of the population moves savings towards safer assets. And in addition, for example, the volatility of inflation in other countries drives demand for US Treasury. So there are a lot of factors. And on top of that, obviously, technology, income distribution, other factors, migration, all things that could be changing, right? We don't know if they're in a permanent state right now.
Okay, I'm going to open it up to questions here in a second. My last kind of couple questions relate to what you just said. So you've got technology kind of having an effect, and I see that in a couple of ways. One is, what's the impact on productivity? And then given your incredibly strong background in labor markets, when you think about technology and something like AI, how is that going to affect labor markets longer term? How do you think it's going to affect some of the productivity measures, and how does that play into your view of the economy going forward?
Yeah, that's a very good question. Again, this an area that faces a lot of uncertainty and a lot of error in terms of how we measure it, even though I've spent many years measuring productivity and in particular TFP. But what we know is productivity growth was at around 1.5% before the pandemic. It seems to have gone up to around 2%, and even some would say 2.6% in more recent years. So it seems to be going up. But we, again, don't know how much of this is permanent or not. What we do know is much of this has been driven by TFP. And TFP seems to come, these changes and increasing TFP seem to come on the one hand due to new entry of businesses, new business incorporations, which really went up by a lot during the past years, 22, 23 in particular, but continue to go up. These new businesses tend to be more productive. And many of these firms are going into new technologies. So that drives up productivity. The other factor is what you mentioned, potentially AI. But I would say here, we're in more tentative grounds. We don't really know. We think AI is probably like a general purpose technology, like the steam power, like electrification, right? It can have many applications, but we just don't know yet, right? That's potentially what it can do. On the labor market, I do think potentially AI can have different effects. It can displace some tasks, not necessarily workers, but some of the tasks that those workers actually do. It can be enhancing in terms of the tasks that some other employees do, for example, those in R&D, and it can even enhance tasks and create new tasks. So it's not clear which way it will go in terms of generating unemployment, increasing unemployment, or decreasing unemployment. I think we'll just have to see. I think also many of the investments that are needed for the adoption of AI have already started to happen. So this is a little different from the technological change and adoption that we saw in the late 1990s and during the 1990s, in the sense that the data is there. Many of the investments in semiconductors and chips have already happened. But you need data centers, you need other infrastructure, you need trained workers that can use these technologies. You need many other things still to happen. So there is some promise, but I would say one should be cautious. There is a survey conducted by the Census of business trends and outlook that actually shows that there has been quite a bit of adoption already, not only in the IT sector and professional services, but across the board. In some 15 sectors, there has been adoption by 20% or more firms in each of these sectors. So it is starting to happen, but we just don't know quite yet where it will take us or how fast it will happen.
Right. All right, I want to open it up. We have, I apologize. Jason gets first priority because he should be up here moderating probably, and I should be listening to him, but Jason?
It's great to see you, Adriana. That was a terrific talk. I wanted you to tell us how you sort through and try to extract the signal from all the noise in the labor data. And I'm going to flesh this out, some of the things here for the sake of the audience, things that you know. The establishment survey, which asks employers, has been running much higher than the household survey, which asks workers. So how do you look at those two surveys? Sometimes the unemployment rate is moving a different way than that month's job numbers. The establishment survey itself keeps getting revised, and we just had one of the largest revisions in a very long time. So when you look at the numbers now, do you think, oh, this one is going to be revised too, and you're adding some type of adjustment to it? And then finally, sorry, it's a big question. You can answer whatever subparts you want. How do you think about what break-even job growth is? What type of payroll growth are you looking for in steady state? And how do you know what that is when we're uncertain about things like immigration?
Great question.
So, Jason,
That's a question because I don't know the answer. I'm hoping you do.
Jason modeled what I asked you to do earlier. He identified himself. He asked not one question, multiple questions, but we'll forgive that. And he did end with a question mark. So I wanted to give you a second to figure out.
Absolutely. Great question, of course. And again, I remember going back and forth back in the day when we had to work during the Great Recession, looking at revisions, payroll data, unemployment data from the CPS. In my view, actually, I think we need to look at the totality of the data. We cannot pick and choose one measure and another. But I would say both the payroll data and the unemployment data point towards softening and cooling of the labor market, both of them, right? Why? We have seen unemployment trickle up, not by a lot, but it has come up. It's still at historically low levels, but it has gone up. If you look at measures of unemployment, and you know this very well, not only U3, but U4, U5, U6, which include discouraged workers, marginally attached workers, part-time workers, they show the same picture. So that all points towards cooling, an additional cooling. The payroll data too. I think the payroll data, you know, we had 500,000 jobs a month created in 22, in 23, it went down to 300,000 a month. At the beginning of the year, even at the beginning of this year, it was at 267,000, and now we're at 116,000. So that shows increased softening and cooling. And you're right that there are revisions to these data, so we're mindful of that. Most revisions have gone in the same direction. They usually go down. So we don't expect that all of a sudden, right, numbers will jump up and we'll find out that there was no such cooling. What it points to is that there is cooling. But as I said before, and we remember these numbers back from the day, you know, a very soft number, a very low number for payroll is below 100,000, and we saw months when it was at 0 at the time, right, during the global financial crisis. We're not there, so the number is still solid, but I think we have to be mindful that there could be even further revisions down the road. The QCW suggests there could be some further revisions because of the birth-death model, so that could further reduce it down. But we don't know yet. We'll know probably in January. We are anticipating that is a possibility, certainly. And as you said, we want to compare that to the break-even number. The break-even number being the level of jobs that is consistent with a constant unemployment rate, with keeping the unemployment rate where it is. So given immigration, you're right. That number is estimated anywhere from, I've seen, from 100,000 to about 230,000, depending on who you ask. And you have, you know, the San Francisco Fed, the Brookings, our own economists at the Fed estimating these numbers. There's a big range. So we don't know. But the issue is we could be already heading into a situation maybe where the break-even may be above where the actual payroll number is, or they may be very close. Right now, they seem to be still overlapping, which is why we felt, right, that it was important to take steps now and to front-load those cuts. In terms of labor demand, we not only look at payroll data, but we also look at vacancies. We look at hiring, and the hiring rate and the vacancy rate also showed that cooling. So again, we look at the totality of the data, the whole constellation of data that is available to us to kind of form that picture. Because you're right, data gets revised, and we don't quite know where we are at a point in time. And by the way, we also look at soft data, right? So stories that are told in the Beige Book and stories that are told in earnings reports by business leaders, but by consumers as well. So all of that shapes and forms where we think the economy is, because these hard data may be more exact and better measured, even though it gets revised. But the soft data may provide you more of a real-time picture of where things are heading next. So we like to use both. And we, again, like to use the totality of the data, because no one data point and not one data series will allow us to be sure where we're headed. Thank you.
That's all the input into the appropriate recalibration process.
Yes, absolutely.
Paul, and then here. Did you have a question, Paul? I'll make sure we get to both.
Okay, I've lost my voice.
I'm so sorry.
I'm not infectious, but so my question is going to return to John's question about R-star, which you said you couldn't answer, but I think you did answer in your words, and it was very intriguing. I want to start by saying that what has been striking in recent months is language from Jay Powell and yourself that has shifted from rhetoric towards risks to inflation towards a flip to risks to jobs. I mean, Don Cohn, a great friend of mine and the most cautious and reluctant Fed critic in the known universe, noted that kind of rhetorical shift, which fits with risks to inflation, symmetric, risks to unemployment, asymmetric is the language I would prefer to use, and that would make sense. Then you say, so why would that be? What kind of shock have we had? And then you said something very interesting. You described policy as very restrictive. So when John asked about where you think the natural rate is, you understandably answered in terms of long-term concept, etc. But of course, actually, when you're setting monetary policy, the big thing is to get the sign right. Do you mean to stimulate demand, or do you mean to hold back demand, and whichever one it is, are you actually doing that? And the second part of the question implicitly requires a judgment, not necessarily a funny Williams-Laubach research paper, but a judgment on whether you're actually being restrictive. And you said we're being very restrictive. And I wonder, my question is, what led you to that judgment? And does it fit with the soft landing, as Americans call it, that you've had so far? Because if policy were very restrictive, I think my guess is that the ride would have been bumpier than it has been. Thank goodness. I would guess is that policy has only been mildly restrictive, but perhaps something has happened recently to make it, in your judgment, very restrictive, and maybe you're right.
So I don't think I said very restrictive, but if I did, I think it is restrictive, mainly because we're seeing moderation in those interest rate sensitive sectors. That's where we're seeing the restrictiveness coming in. And we have measures within the Fed that looks at this FCIG and other measures that we pay attention to in terms of how restrictive our policy is on the real economy, either through interest rates, through equity prices, to exchange rates, right? We look at all of that. That's where this comes from. Now, if this inflation continues to happen and it's already restrictive, it will just become even more restrictive moving down the road. That's the way we see it. That's why we think we need the cuts, even just to keep where we are now in terms of restrictiveness. And we're thinking, you're right, we do think that we have more confidence in terms of this inflation continuing to move to the 2% target. Why do we think that? Well, at the beginning of the year, you will remember, in the first quarter of this year, we had some bumps in the road, right? There were increases in inflation measures, and there was the concern that maybe inflation was going up again. And that's why we held steady and we said we need to hold higher for longer. And that was pretty unanimous, right? So I think now, in retrospect, we can say part of that was probably due to one-off factors, including increases in import prices, but part of that was also probably due to residual seasonality. So given that we've now turned back, we're back on a good trajectory, we feel comfortable on that side of the mandate. On the other side of the mandate, as I said, I think we are and we're facing a labor market that is resilient, that is in a good place. What we don't want, given that we have seen that rebalancing between supply and demand, is for that to go farther, right? We don't want demand to fall so much more relative to supply that is at a moment when it's not actually necessary. Because as I said, the main way in which the labor market also affects inflation is through this wage growth. And wage growth moderation has taken good hold. It has been coming down, and it's unlikely to be generating now inflationary pressure. So given that, it makes sense to cut rates so that we remove some of that restrictiveness. I don't think it's excess restrictiveness, but it is certainly way above any of the measures of the neutral rate that anyone is ever thinking of, right? Even within that range, we're already above that. And if this inflation continues to happen, the real rate will continue to come up, and our level of restrictiveness will just increase over time. And that's why we think we need to remove some of that restrictiveness.
Last question.
Thank you. Juan Saavedra from the Harvard Kennedy School. Adriana, I wonder if you can comment on how the Fed sees the interplay between the current direction of travel for the Fed's fund rate that you have highlighted with long-term interest rates and the Fed's stance on the shrinking of its balance sheet.
So we don't see them as going together. I mean, it is the Fed funds rate that determines our stance of monetary policy. The reduction of our balance sheet is something that is happening no matter what, but we don't see that as being a key part of how we're achieving our mandate, our dual mandate.
So last week, I think, Jason, you wrote something about the 50-point reduction, and it was a bit of a, not necessarily a victory lap, but a little bit of a champagne cork, because it seems like the Fed has done its job reasonably well. I don't want to put words in your mouth, but something along those lines. But I want to thank Adriana for coming. I thought this was terrific.
Let me just say, we're not celebrating. We don't think we're there yet, just to be sure. We are not.
That's why I put the words in Jason's mouth,
think
not in yours.
We still need to get to the 2%, and that's still very much our commitment. We're nowhere close to celebrating. We're keeping our eye on the 2% target and continuing to keep a resilient and healthy economy. So that's where we are. We're not celebrating, none of us.
I think that's a great ending to this conversation, and I want to thank Adriana for coming, and thank all of you for coming as well.
Thank you. Thank you so much.